Welcome to Alpha Recap from stockalpha.ai, the quick, sharp wrap of today's market moves. Markets closed with a selective rotation after the bell, and our focus today is on how policy headlines and big capital moves drove that rotation. As always, if you have questions, you can reach us at stockalpha.ai.
Nice to be here. Today felt less like one big market catalyst and more like a series of targeted decisions. Investors piling into real assets and energy projects that deliver cash sooner while pulling back from policy-sensitive names in healthcare and cannabis.
Exactly. Real estate dominated the headlines. Big financing, big leases. The most visible was Ken Griffin's majority joint venture on a midtown supertall, and Affinius provided a $115 million loan to finish a Manhattan multifamily tower. Those deals signaled real money was redeploying into trophy urban assets.
That's right. When a heavyweight puts capital into a marquee project, it has a halo effect. Alongside that, the Mortgage Bankers Association forecast suggested commercial originations could jump by about 27%, which hinted banks and lenders were starting to loosen up for quality deals.
Put simply, investors were favoring near-term cash flow. For buy-and-hold folks, more leasing and financing in core markets can tighten cap rates in selective pockets. For credit investors, improving commercial origination expectations pointed to potential opportunities in commercial mortgage-backed securities and CRE lending platforms, with the caveat that office and secondary markets still carried risk.
Good point. You've got to be selective. Not all real estate is created equal right now. Core urban multifamily and trophy office in prime locations looked different from regional office assets with weak foot traffic.
Moving to energy, that sector finished the day with clear tailwinds. Geopolitics helped oil and gas. Siemens Energy reportedly posted record gas turbine orders, and energy storage projects were getting attention. But it wasn't a clean bull market for everything energy. Solar faced cost and permitting questions, and federal EV charging programs experienced delays.
So the takeaway for energy was, be tactical. Favor integrated names that benefit from higher gas prices and storage economics, and developers with contracted offtake. Avoid one-trick solar plays where interconnection and permitting are the gating items.
Exactly. Materials and mining also had a good day. Permits in Quebec, a spodumene supply memorandum of understanding, and a joint venture in Idaho for antimony processing. Junior drillers restarted operations, and some majors reported operational gains. That moved the needle for battery metals and defense materials.
This was important because investors are moving from exploration bets to projects with clearer timelines. When you see permitting and offtake MOUs, you are closer to actual production. Sovereign-aligned projects, the ones aimed at onshore supply for AI and defense, may command a premium, but they carry political and regulatory complexity.
On the other side of the ledger, healthcare and cannabis were pressured by policy headlines. Healthcare felt the pinch from potential Medicaid and Affordable Care Act subsidy shifts, which can change payer revenue and provider margins quickly.
Policy risk is the elephant in the room for healthcare. Even with some bright spots in AI-driven R&D or promising medtech, near-term liquidity and coverage uncertainty can drive rapid repricing. For investors, trimming duration on policy-sensitive payers and providers made sense today.
Cannabis suffered from state-level moves. Oregon proposed capping THC per edible, and Ohio saw political pushback. Those kinds of regulatory changes can force companies to change product SKUs and margins overnight, so the market punished single-state or single-product players.
Right. For cannabis, the playbook is now diversification, compliance, and manufacturing flexibility. Operators that can pivot SKUs or lean into hemp and lower THC products were better insulated from that kind of shock.
Let's talk technology and communications. The day was mixed. There were distribution wins like the Disney Sky deal that promised to broaden content monetization in the UK and Ireland. But there were also ad sales disappointments, like ad weakness at AMC, and a Windows zero-day security issue that flagged platform risk.
Distribution deals act like revenue stabilizers for big media owners. If you broaden reach and can bundle content, you often smooth out ad cyclicality. But when ad demand softens, companies that rely heavily on ad revenue get hurt fast. And infrastructure risks, like a major zero-day, remind us that platform stability is not a small issue for monetization.
In tech more broadly, we saw a split day. AI product rollouts and recurring revenue growth for some software names balanced out against security and infrastructure concerns. The market rewarded near-term ARR growth but penalized long-duration risk where the macro picture tightened.
Yes, and on finance and banking, a stronger January jobs report tightened rate expectations and introduced volatility. That pushed credit spreads and made long-duration assets more rate-sensitive. There was also a smattering of M&A and activist activity, which created mixed signals across the financials complex.
So banks with variable rate assets and strong deposit franchises weathered it better than institutions with heavy commercial real estate exposure. Credit investors should have been watching net tangible assets and coverage ratios more closely after the jobs data hit.
Utilities were another mixed bag. There were funding and partnerships for virtual power plants and EV charging builds, but federal policy rollbacks and research layoffs highlighted downside risk to long-term build-outs. Some projects were reportedly canceled, and the report mentioned about $35 billion of lost clean energy projects, a big number that reduced predictability for some names.
That figure mattered. It underscored the risk of relying on ambitious federal incentives without firm project backlogs. So favor utilities with a regulated rate base and contracted project pipelines rather than pure bets on federal incentives being delivered on schedule.
Crypto also had its usual tug-of-war. Spot Bitcoin ETFs were still drawing inflows, and product launches from exchanges and payments players expanded the on-ramp picture, but enforcement chatter and macro volatility left price action choppy. The message for investors was position sizing and using regulated products if you wanted core exposure.
Meaningful practical advice there. If you wanted Bitcoin exposure, spot ETFs provided custody and regulatory clarity versus unhosted wallets and smaller exchanges. That's less about speculation and more about how you manage counterparty and custody risk.
We also saw consumer and retail moves toward direct-to-consumer channels and AI in marketing. Examples in the tape included retailers testing AI ads and a big consolidation, a deal reported around $2.25 billion, that signaled strategic scaling to capture operating leverage.
Right, and those DTC initiatives can re-accelerate top line with lower incremental capex if the unit economics hold. But inventory stress and discretionary spend exposure remain risks for some names without strong loyalty or proven LTV recovery.
On materials and industrials, operational wins, like restarted drilling and new JV formations, meant nearer-term output for critical materials. For industrials, incremental capex at the facility level and repeatable cost savings made some companies look like steady, if unspectacular, performers.
Before we move to takeaways, let's translate a few technical terms we used for listeners who want plain language. Offtake is simply an agreement to buy the product your mine or plant will produce. It gives revenue visibility. Interconnection is the process of getting a renewable project connected to the grid. And cap rates in real estate are the yield you earn on a property. Lower cap rates mean higher valuations.
Good clarification. Also, when we say duration in a portfolio sense, we mean sensitivity to interest rates. Long-duration growth stocks get hurt when rates rise because their future profits are worth less today.
Let's wrap with clear takeaways investors could act on after today's market close. First, tilt into real assets and energy projects with contracted cash flows. Those assets gave investors clearer near-term yields in a higher rate environment.
Second, be selective in utilities and renewables. Favor regulated utilities and developers with firm interconnection or contracted offtake. Project execution mattered much more than simple policy promises this session.
Third, hedge policy risk in healthcare and cannabis. For healthcare, focus on diversified payer mixes and strong balance sheets. For cannabis, prioritize vertically integrated operators with multi-state footprints and compliant manufacturing able to pivot product mixes.
Fourth, use regulated crypto products for core exposure and size positions to withstand headline volatility. And fifth, screen materials and industrials for permitted projects and offtake agreements before committing capital. Sovereign-aligned projects can be strategic, but politically complex.
And one final portfolio note. The strong jobs print tightened rate expectations, so duration management was a live issue. Prefer businesses with faster cash conversion and quicker earnings visibility if you want to reduce rate sensitivity.
Looking ahead, the three catalysts to watch were earnings and guidance season, policy updates at federal and state levels, and project execution milestones like financing closings and permit-to-production news. Any of those could widen or narrow the dispersion we saw today.
All right, to close, today was a story of capital rotating into cash-flowing real assets and energy, while policy headlines pinned healthcare and cannabis. Sector dispersion rose and stock selection mattered more than ever.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening.